The truth is that in reality, this particular lesson topic wasn't actually part of my curriculum to teach you. But the truth is that during this time, my friends, but I've received so much kindness and love from you. And I've seen how much you show your support to us, aside from the messages and telegram you sent to our support. And aside from the many messages you've sent me personally, many of which I haven't even had time to open and read, though I see the notifications. And besides that, in most of the Telegram channels I see, you've talked about us and shown so much kindness regarding our advanced course being held and how much it has helped you essentially with your growth in the field of trading. Honestly, when I saw all of this, I really saw how wonderful you are, and I couldn't bear not to give you some more tips and tricks. I've come back to the sweep to teach you some more subtle tricks, especially regarding the TTW indicator to you. It wasn't supposed to be a lesson topic, but I truly felt that all your kindness must be repaid with kindness from us. In this session, we're going to talk about the sweep and spike strategy, those remaining tricks on the indicator TTW, on the TTW, and I'll tell you about its settings on the TTW. Regarding the TTW indicator, we are the first ones to make version 3.7.5 completely public last year, and this was simultaneous with the version we released from Bookmap. And I also intend to fully deconstruct this version of the indicator in this course. I mean, even the creator hasn't done such a thing. And in the version they made public in 2021, I think it was version 3.3. If I'm not mistaken, they only gave a very brief minor explanation. I'm going to fully deconstruct version 3.7.5 and I'll teach it to you in a way that even the creator hasn't spoken about yet, and I'll do this for you. My dear friends, let's move on to our first slide. In the previous session, we discussed in considerable detail about sweeps, and in the introductory course, we thoroughly explained what a sweep actually is. I also mentioned that sweeps are, in essence, typically triggered by algorithms operating within the market. Here on this particular slide, you can see that we've enabled TTW in our indicator and gone to the section related to sweep signaling. And I want to explain the sweep related settings in TTW to you to show exactly what they are. This checkbox here enables the sweep signaling on your chart, and these two options, buy sweep signal and sell sweep signal, which relate to the actual color that displays that signal on your chart. It's nothing special. You can change its color from the edit section. Here, trigger volume is the amount of volume that activates your signal. For example, if you set it to 500, it will show you any sweep that has occurred from 500 and up. Trigger volume stop relates to those sweeps that are of the stop type. The settings for this are also similar to that one. Now, if you didn't get this or don't quite understand, I'll explain it to you later, don't worry. Price range, which is also in ticks, is exactly what we said in our sweep discussion, that they sweep a certain range. This relates to showing us from what value and up. From 2 and up is usually logical. 1 is useless, it shows nonsense, and a 1-tick sweep means nothing to us. We're looking to see 2 and up in the market, so that's that. You can specify the range of those ticks. You can select Show Order ID to show or display the order ID associated with that sweep for your reference. My dear friends, a sweep happens via a single machine ID or order ID, not several, meaning one entity performs that sweep. It's an algorithm, and its order ID is provided by the level 3 data, that MBO data we're receiving. It's captured and then displayed, meaning it's identified, and if you have this set to the enabled mode, it will also show you the other party's order ID. I'll talk about stop traces later. Just keep this in the back of your mind for now, and I'll explain it to you further on. And these ones relate to the settings for alerts and, notifications and things like that. There's not much else to it. And when that sweep signal of yours is triggered and it shows it to you, you might not actually see this particular part, meaning you only see this specific range. So you notice it just says a range. Well, that's because it simply couldn't identify it. But for the ones it could identify through the algorithm this indicator was written with, you'll see a section where, first of all, the range, which is our price range, says a 9-tick sweep occurred here. Okay, it has a section called active A shown as A. Now you see here that out of 100 volume triggered, 45 were on the side, essentially the aggressives or actives, and 55 were on the passive side. However, these 55 were either executed and consumed, contributing to that sweep or not. They were not executed at that time, and instead they were held and then used later, remaining present and visible in the order book. Even after this, it is possible that the system might have removed those 55 passive orders it had previously entered, removed from the order book, and did nothing special with them. Excuse me. And this is the story, meaning this is the information it gives you. Because look, a sweep happened, that machine ID was identified, and now it's seen that sweep on its active side. Well, it swept 45 aggressively. That same machine ID also had 55 orders in the order book. Now, whether that order helped in the sweep that occurred, whether it was involved is unknown, whether it was used later is unknown, or if it was removed from the order book later is also unknown. This is the information it provides, my dear friends. And the strategy you should always consider for sweeps is that for the sweep you see, for example, if it's a buy sweep, you should see if in its path, meaning upwards when it's a buy, do we have liquidity or not? If we do, naturally the price intends to move in that direction, my dear friends. And on this side, as you can see, various sweeps. Now, this chart here had a range of 1, but if we ignore that, for example, you see a sweep that has occurred. 88, 4 range, meaning it was a 4-tick range where our sweep hit 53 in active and 35 in passive. And you see that heavy long-term liquidity was at the top and the price tendency was to move upwards. And that's the direction you should enter a trade in after seeing the sweep. Let's go to the next example. Look at oil. In this image, I'll tell you exactly what happened. In this image, you see that we have multiple sell sweeps. Let's do a quick callback to something important. Remember, Elias mentioned in his level 2 advanced course that in oil, we see a lot of sweeps or stacked imbalances. Friends, I sincerely hope you remember and have seen Elias's courses. If you haven't seen them at all, what exactly are you doing here? And as I've told everyone many times, level 3 concepts are meant to complement level 2 concepts. If you don't know level 2, then level 3 is only somewhat helpful. But if you really know level 2, that's when you can see the miracles. And if you remember, Elias said in his advanced course that in oil you see stacked imbalances and multiple sweeps. Consequently, when you're working with oil, it's very good to set your sweep range to 5 or 6 because you see a lot of sweeps in oil. That's one point. The second point is, look here, we had a lot of sell sweeps, okay? But where exactly is our liquidity? It's actually positioned above the price, not below it. And as you can see, it's multi-layered, meaning that it is both old and multi-layered. So you shouldn't fall into the trap of selling or shorting the market just by seeing sell sweeps. Absolutely not. You should be looking for buy sweeps. Because if you see a buy sweep occurring and there's liquidity above, naturally the price momentum and movement will be towards that liquidity and you should conduct your trade based on that. Now, why I say you shouldn't have sold on those sell sweeps, you'll see in the next slide. I mean, if you had done that and fallen into this trap, you'd be wiped out. As you can see, the price went up and was absorbed by its liquidity right here, and now after that they've placed a heavy amount of liquidity right here, and this price has also moved and even consumed these liquidities. And here we have reached something interesting, very, very interesting. You look here, and if you pay close attention, you'll see a buy sweep has been activated here, but it's different from the previous buy sweep we saw. Let me pull that up. The buy sweeps you saw here were triggered in green, but here, this buy sweep you see is blue and it has an S written in front of it. My dear friends, this is a buy sweep that is of the stop type, meaning it was a sweep that was the stop of an algorithm. Well, my dear friends, as you can see, your stop iceberg indicator is showing that stop and it has triggered 52 units of volume. This line is 100 and it's reached halfway, which is 52. I want to say that when you see this S, pay attention, my friends. Okay, it means that your sweep was of the stop type, my dear friends. Okay? Guys, did you understand it? I hope you did. And where I told you that you can adjust the trigger volume stop is for seeing this type of stop. My dear ones, if you had set it from 50 downwards here, you could have seen this because it's above 50, it's 52, and it's displayed. But for example, if it were 60 here, you wouldn't be able to see it. Okay, guys, pay attention. So the settings in this section are for seeing this type of sweeps that are essentially of the stop type. It has an S in front of them. Okay, so you've also really understood how to adjust it, am I right, guys, or no? And one thing I actually really wanted to tell you, you see, for example, when you see a buy sweep, I said you must check if there's liquidity above it or not before entering. You see, we don't have any significant liquidity up there. Our main and heavy liquidity is below. But one strategy I want to give you regarding is this model of buy sweeps that are of the stop type is this, my dear friends. Look carefully, please, guys. Please pay attention here, guys. Okay, my friends, there was an algorithm that had opened a sell trade, okay? Because you see, the buy sweep has been stopped here, meaning its stop was a buy. What kind of trade has a buy stop? A trade that was a sell. So our indicator that essentially the algorithm, our algorithm had opened a sell trade, and naturally it was quite right to do so because the main heavy liquidity and market attraction were down here. That upper liquidity had already been consumed. Those liquidities that were there have been used up, and we no longer have any attraction at the top of the market. Now the main attraction is below. Our algorithm, that algorithm had correctly taken a sell. But well, market pressure came in and pushed the price a bit higher, and this algorithm got stopped out. I want to tell you, this is a key tip. This is the result of my experiences. It's not always like this though. But in 70% of cases, take this as a legacy from me. This type of signal you get, meaning that sweep, which is of the stop type. Well, if meaning right now this is a buy sweep and it's been stopped, meaning your algorithm had taken a sell. And if you have heavy liquidity below you, that area is a good area. A sweet area, in English, they call it a sweet spot, a sweet area. It is for your entry towards that liquidity. It's not always like this. You must definitely have liquidity below. Now, if a buy sweep stop happened here, if we had heavy liquidity up here, then no, you wouldn't do this. But now you see that up there, it's not at all attractive. The main attraction is down here, and we had an algorithm that intended to move downwards, and due to market pressure, it's also been stopped out and right where it stopped. It's a good sweet spot for you to trade in the direction of the drop, which you see has happened, my dear friends. Let's move on to the next example to see another buy sweep stop again. You see this one too is blue and has an S in front of it, and it's of the stop type. And this one is exactly the same way, meaning it had opened a sell trade and got stopped. Now, what is this line you see here? I told you about this line in the settings. I said leave it. I'll tell you later. It's exactly for this reason. Unfortunately, my monitors have started turning off now. I need to press the button to stop them from turning off. I have to interrupt my explanations for a few moments and we'll be right back. Okay, my dear friends, sorry about that. These 4 monitors of mine were counting down 1 minute and saying, if you don't push the button, I'll turn them all off. Right in the middle of recording, I was saying that this line you see here relates to, regarding this option I mentioned I'd explain later, stop traces. If this is enabled, it will take that stop, which is essentially from the sweep that was stopped there. It then follows our stop and tells you exactly what happened to it in detail. Of course, after another sweep is triggered, the process continues as before. Okay? And now, what was this? This guy had opened his trade as a sell and his stop was around this area where it got hit, and this stop trace followed that stop and informed you. And now we'll show an example where the person actually moved their stop. And since this was in the market's past, it notified us after the sweep was triggered. I'll show you the example. Guys, another thing I need to tell you, look again now. For example, to trigger this kind of stop, the volume you set for your stops here. should have been 30 or less because this 31 triggered above that and is shown to you. For instance, if this were 40 here, it wouldn't show it to you. So I want to tell you to pay attention to the settings you make here, both for trigger volume, meaning sweeps with normal volume that aren't stops, and for sweeps that are stops, please adjust these volumes according to your needs and the instrument you're trading. If you don't set them properly, friends, it'll become a total mess. Like this slide you see now on NASDAQ, it shows all these weird signals. Your chart gets unnecessarily cluttered and you won't know what to do. So my advice is to please set them correctly. Let's go. We've seen the buy sweep stops. Now let's look at the sell sweep stops with the stop tracing feature. Look, a sell sweep stop is a stop that was a sell and also a sweep. Well, which trade stop was a sell? The stop of a buy trade. Meaning some poor soul started buying in this area, but according to what they wanted, it didn't go well, the price dropped, it crashed, and well, their stop was hit. Or here as well, but well, this goes back further. You'd have to go back and see what the story was and what happened. This is also a sell sweep stop. Let's look at an example where the person actually moved their stop. Look, we had an algorithm that had opened a buy trade, okay? And for this trade, the price went higher and higher, and it moved its stop to a higher level, meaning it changed its stop and placed it within a higher price range. As you can see, when the price eventually returned, it was stopped out right here. I mean, I want to tell you, after this sweep here gave you its signal, well, because we had the market MBO, and well, this indicator that was written used that MBO. The other machines, the person had went and saw how they'd placed these orders in the market. Here, with this line you see, it told you exactly what they'd done earlier and how, for example, they changed their stop. All of this is shown to you after this is triggered, and you can now use this feature. And that's that, okay? Here in this chart that you see now, which relates to the S&P, you see that we had a lot of sell sweeps here. Sell sweep, sell sweep, sell sweep. And look, you should not have traded under any circumstances upon seeing these significant sell sweeps, meaning you shouldn't have shorted at all. Why? Because in this range, we are in the -2 standard deviation range. Friends, if you haven't seen the topics related to level 2 and Elias's course, I beg you to close this video right now and just go, don't even show up here, friends. If you don't know what -2 standard deviation is, what I'm talking about, then you shouldn't be here. This is where we have seller saturation, and you should not trade in this range under any circumstances. It's a pure mistake, friends. I mean, this is no longer the place to hit sell, okay? In -2 standard deviation, there's no place for selling, okay? No one else mentions this point, okay? It's only us saying it. It's FOMO that's telling you to. And I hope you're really paying attention to this story and keep these fine points in mind. Friends, my dear friends, look here, please. Here in gold, which was 2 days ago, an interesting thing happened. These examples that you're all seeing, this entire PowerPoint I'm showing you now, relates to these past 2 days. I mean, I decided over these past 2 days to record this course, this part of the course actually, and all the examples are from 2 days ago. And sorry, my voice is a bit raspy today. Sorry, my dear friends. Now, 2 days ago, you see we had the gold chart, and a very interesting thing had happened. And now I want to tell you exactly how you should have traded it, which, as it happens, I also placed a trade on. Of course, I entered a bit late because I was like taking screenshots of these slides. I was watching several instruments at once, so I entered late myself, but I did execute that trade and I'll show it to you. Well, keep this in mind. Let's first go to this part of the market at that moment. And where I had taken a screenshot for you. See what happened. It's on gold too, friends. Take a look. We had a buy sweep where some liquidity was present. Well, at the moment the buy was made, they weren't there. Then a bit later when it dropped, these liquidities were placed at that market moment. Well, there was no liquidity, no story. I didn't make any trades. But anyway, they placed the liquidity later and the price got attracted to that. And after that, meaning around 1540, around 1542, 43, they came and placed a heavy long-term liquidity here, my dear friends, below the price. Well, from then on, I mean, as I was watching the market and I was taking photos for you one by one, hoping to fill this part, which is exactly what happened. I was waiting to, well, basically see a sell sweep happen, meaning if I saw a buy sweep, I wouldn't enter at all because I didn't have any specific liquidity above me. My main liquidity, specifically my heavy liquidity, was below the price. So I was waiting to observe a sell sweep, to see a sell sweep, or according to that, what I said, I was waiting to see, for example, around areas like these, a buy sweep of the stop type, meaning to see a stop buy sweep, meaning to see that there was an algorithm that came and took a sell. And look, guys, due to pressure of market time, for example, in these areas, and its stop was hit, it became a stop buy sweep and showed me there. And now it's basically a sweet spot. It's a sweet point for me to want to take my sell. I was waiting for something like that, which again, I didn't see. Okay. The price comes forward, goes further, and this happens as it goes further. It gives me a sell sweep in this area, and I see, awesome, it gave a sell sweep, and my liquidity is also below the price. Naturally, we enter it, though I entered late, because I was busy while I was monitoring other markets. This slipped away from me a bit. I entered later, but I made my trade, even though I entered late. Friends, look at my risk to reward. It's 1 to 10, and I entered. At the moment I took the screenshot, it was 118, but when it hit its TP, it was 146. I mean, I made a profit of $146 in 5 minutes, just like that. And you see the price was pulled too. It's exactly towards that liquidity, and if I hadn't entered late, I'd have easily made 200. See, you cost me. I'm just kidding around about this part, but I really want to tell you that this is how it is, my dear friends. And very easily, simply by seeing that sell sweep and seeing that liquidity that was right there, you can see that the market's intention is to move towards that liquidity, the heavy liquidity we have, and that exact trade happened. Even though I entered late, I still want to make sure everything is clear. And that's that. Let's go ahead and get started because I want to talk about spikes in detail. The main reason I included spikes in this session is because of their similarity to sweeps, which is an important point to understand. I mean, sweeps and spikes, when you look at them closely, share several characteristics that are worth discussing. They're very similar and have slight differences that I'll tell you about, and many in the market mistake these two for each other. They mistake sweeps for spikes and spikes for sweeps. It's very important, meaning you level 3 practitioners, much better than those working at lower levels, can understand the difference between these two, understand where a spike occurred and where a sweep occurred. Now let's examine spikes together to see what they are, my dear friends. What's the difference between a spike and a sweep? It's in these things I'm about to tell you. I told you, I said a sweep happens via a machine ID, an algorithm that performs their sweep, and that's it. And now if we want its order ID, meaning if it's identified by the market, if we set our indicator so that if it's enabled, if we activate it, it also shows us the other party's order ID. But in the specific case of this unusual spike, my dear friends, there are actually several different machine IDs and several unique order IDs that are causing that sudden spike, my dear friends. And now, let me draw a little something for you. What do you think about that? Are you okay with a quick drawing? Let me draw a straight line right here and another line over here, my dear friends. Just take a close look at this. In a sweep, it's one person who hits it, performs the vacuum, and sweeps this range. It's a single order ID. But in a spike, my dear friends, it's several people, meaning one of these is hit by, say, Elias, one by David, this one by Jason, this one by George. Then maybe Elias hits again, then I don't know, maybe Kamran hits. I want to say this belongs to several people. Okay, that's that. The time element in a spike is in fact an element that is actually open to discussion or interpretation, meaning that is to say we have spikes that can be classified or sorted based on time. My dear friends, the shorter the spike's time and the more vertical it is, the better its validity level is, meaning the element we don't have in a sweep is the time element, whereas in a spike we have the time element, my dear friends. The other element is the ratio element or the proportion element. And what is the ratio? It's essentially the ratio of those traded volumes on the bid side to the ask side or the other way around. So if I want to tell you we have a ratio in a spike, I'll bring up the indicator for you to see, which essentially takes this ratio of volumes that came to buy to the volumes that came to sell for our spike. That is the buying versus selling activity. And this also differs between sell spikes and buy spikes. Okay, my dear friends, did you got it? I hope you got it. Meaning your buy volume spikes ratio is calculated in a way that it's the buyer's volumes over the seller's volumes. But conversely, for a sell volume spike, they divide the seller's volume by the buyer's volume. Okay, further ahead, if you didn't understand, it's okay. I'll show you this ratio on examples later. Don't worry at all. So we also have a ratio discussion in spikes that we didn't have in sweeps. So time and ratio, that's that. The price range is just like a sweep, exactly that tick where the spike moves. The price is what we're considering and discussing. Another point we have to discuss is that, look, in a sweep where one machine ID has moved the price upwards, for example, suppose, for instance, me, Elias, and say David intended to make a purchase. Now, someone named Elias, who I'll say hi to right here, sorry for using you as an example, someone named Elias has come and algorithmically swept this area, okay, meaning he bought right here. Okay, Jason and I also intended to buy, but we didn't get the chance here, and the price moved upwards. And we aggressively bought here again in this zone. I mean that after this, the price was also moved by us buyers upwards. Okay, my dear friends, there was no price exhaustion, meaning we were also people who intended to buy at that market moment. Now, Elias swept and suddenly pushed the price higher. We also placed our buys, and that caused our purchase to happen around here, and the price might move downwards, for example, okay? But in a spike, everyone bought together, meaning me, Arman, Elias, that Jason, Cameron, David, whoever, they all bought together and pushed the price higher and pushed that price tick higher, and all the buyers participated together. As a result, the probability of price exhaustion in spikes is higher than in sweeps. I hope you understand my point. It's not that we don't have price exhaustion or price reversals in sweeps. We do. I'm saying that in spikes, usually because all the buyers participated together and bought, they all joined in together after the spike. That participation has dropped, and for example, the sellers have taken over. I mean, that price exhaustion is usually seen more in spikes than in sweeps. This is another difference that spikes have with sweeps that I wanted to tell you here. I hope you also enjoyed my beautiful drawing. Now let's go and examine the examples together. Before that, I should give an explanation on TTW regarding how its settings are. Under those settings related to the sweep, you have the volume spike settings here, which enable the spike-related signals for you, my dear friends. So by clicking enable, it gets activated. These two, just like the sweeps, will display the spike signals for you using the specific colors you've selected right here. It shows them. Buys are in green and sells are in red. Here, the trigger volume, exactly like the sweeps, handles the volume for the spikes. You need to set the volume level you want to see here. It's the volume filtration for the spikes, okay? You have the maximum duration, which is exactly that time element we discussed. The shorter it is, the more valid your spike is, and we're actually looking for spikes that occur within a shorter time frame. That's more important to us. So it's much better not to set it higher than 1, keep it at 1. For your price range, you should look at 2 ticks and above. 1 tick is just nonsense, we ignore it. Then there's the ratio. To ensure the ratio doesn't interfere with the signal you're getting, you should set it to 1. The rest of these are related to alerts, notifications, and things like that. Okay, so those were the details regarding the spike settings in the TTW indicator. The spike strategy is essentially just like the sweep strategy. You see a spike, and for example, if it happens to be a buy spike, if you have liquidity above the price and none below, the market will naturally be drawn that way. Or vice versa, if you have a sell spike and liquidity below, the market will be drawn downwards. Some experts, because of that exhaustion factor I mentioned, meaning a spike occurs and then price exhaustion, well, we see the price move, and because of buyer participation, we might see a bit of a reversal. So everyone says that immediately after you see a buy spike, you should enter a sell. I want to tell you that you should never do that. It's not a sound strategy. I'll explain. What the correct strategy is in this example, you see a spike, a buy spike that has occurred, a buy volume spike. Now, at this price, the price range was 7 ticks and its ratio was 5.3. How was this ratio calculated? As I said, if it's a buy volume spike, it's the buyer to seller ratio, meaning buyers divided by sellers. So there were 170 buyers divided by the 20 sellers. It gives us the result. This ratio you see here is 5.3. This is the information it gives you. And as I said, when you see, for example, if you have liquidity above that spike, it's better to trade towards it. As you can see, the price was drawn to the liquidity that was there. It hit it, and then there's liquidity below it. Let's look at the next example. Now, this one is very interesting. Look at the previous example. In the previous one, the buy volume spike you saw was triggered in green, and it was displayed for you. Man, my nose is so itchy today. It was displayed. But you see that in this example, your buy volume spike is blue, my friends. Why? Because its ratio is undefined. Again, why? Because it was all buyers and no sellers participated here. And well, 70 divided by 0 never makes sense. It's not divisible. That's why the ratio is shown as undefined here. Seeing this type of spike is good because it speaks to the purity of that spike. Meaning if it's a buy spike, it's entirely buyer participation. The buying pressure is high. And naturally, when there's liquidity above it, the price intends to be drawn towards it, which is exactly what you see happening. Okay, so you've learned this too. Let's look at another example here. You have a sell volume spike, which is blue again. Why? Because it has an undefined ratio. And as I said, in sells, sellers are divided by buyers. Now here, 53 divided by 0. Well, it doesn't make sense. That's why the ratio is undefined again. And this tells me that this drop was entirely seller participation and no buyers were present. Okay, guys? And the purity of this spike is also high, and you see the price moving towards the liquidity below it again. And now the strategy I have in mind and want to talk to you about. And as I'm saying now, experts and many others who work with spikes say that if you see a spike, immediately enter a reversal because of the exhaustion that occurs. But I say that's wrong and you shouldn't enter in a normal market state. So what's the solution? This is what I want to tell you now. Look. In this example you see here, as the price moved downwards, I see multiple sell volume spikes that have occurred here towards the liquidity, but I won't enter a sell here under any circumstances. Why? Because in the level 2 topic, well, I have Ninja Trader. In, my level 2 chart, if I go and take a look, I see that this area, which also related to the day before yesterday, this area was at -2 standard deviation, meaning there was severe overbuying and also severe seller saturation, meaning that the number of market sellers was extremely high, so high that the market was saturated and the price had dropped enough to reflect this. I would by no means ever enter a sell position just by seeing sell volume spikes here, by no means. And you shouldn't have done that at all, and you should have waited for a buy volume spike. After which you see, man, this buy volume spike happened here. It pulled the price upwards. But again, there's a point here. Look, when you see a buy volume spike in a situation like this, if your liquidity is upstream, it's a huge plus for the price movement. See how the price was fluctuating right here? Exactly because of this liquidity. I mean, look, the price status is at -2 standard deviation, severe seller saturation, and price exhaustion for further drops. But despite this, and despite the buy volume spikes, you see this liquidity that was here again didn't let this price go much higher, acting like a magnet, especially since you see later it got heavier and heavier. They kept making it more and more attractive, okay? That's why further on, seeing, for example, a buy volume spike that was here, I still didn't dare to do anything the day before yesterday. And now let's go further to the next slide to see what happens. This price eventually comes. This liquidity is exactly the same liquidity that was there. This price eventually comes and gets absorbed and reaches this liquidity and consumes this liquidity, friends. Then now this area is the -2 standard deviation area and severe exhaustion of price, severe seller saturation. I mean, consider this like a rubber band, friends. The price has dropped and buyer saturation happened, and here immediately a sell volume spike. I also saw you're in the -2 standard deviation range, a sell volume spike you saw. You should by no means sell, my dear friends. Seller saturation exists. This price rubber band, when you see this seller saturation has happened and sell volume, the spike that comes stretches this further, meaning the sellers are applying their final pressure. This rubber band is now extremely stretched, and especially since liquidity has been taken here, there's no magnet left. There's no magnet to hold the price. This band snaps back and you see how the price moves upward. So our strategy is this: when you see a sell volume spike in the -2 standard deviation range, you shouldn't enter at all. You should enter the opposite way. You must enter in reverse and go for a buy, especially when that liquidity is taken and the magnet that was below the price disappears, leaving no attraction. To keep the price there, you should enter as a buy. So let me review once more. In an area at -2 standard deviation where there's extreme seller exhaustion and you still see a sell volume spike, it means the sellers are delivering their final blow to their own setup. They apply their last bit of pressure and even liquidity gets taken. And once that market magnet is gone, rest assured that in that zone, you should enter a buy. You must enter opposite to that volume spike you just witnessed. Unfortunately, since I was busy taking screenshots of various market areas the day before yesterday, I missed out on trading this. Honestly, the next day, which was yesterday, I went looking for the opposite example. This one was an example of a sell volume spike at -2 standard deviation. I decided yesterday to look for +2 standard deviation and a buy volume spike. To show you, I traded that one and I'll show it to you now. Before we get into it, I want to tell you that part of this spike was also stops. Keep that in mind and pay attention, my dear friends. Look, some people's stops were hit right here. Keep an eye on that. That was our strategy. Okay, my dear friends, now let's go and look at the opposite scenario. Look, guys, and pay attention. Where we had +2 standard deviation. Yesterday on the S&P, it was just yesterday, I executed this trade and took screenshots so that today, thankfully, I'd have the chance to show you. Look, friends, the price came up here, hit several buy volume spikes, and made an aggressive move toward liquidity. And after the liquidity was taken, see why I didn't enter with the buy volume spikes that I saw? Because guys, I had something called Ninja Trader and was well versed in these topics in the name of level 2, which Elias worked his tail off to teach you all of this. And if you haven't seen it, I'm truly sorry for you. And my price in the range, meaning it had entered the +2 standard deviation range, buyer saturation, and I even took a screenshot of the chart for you. See, it entered the +2 standard deviation range, and on the other hand, my CVD, look at it down here, my dear friends, and just look at the contracts, what price and range the CVD has reached. Friends, 19,000, 20,000, meaning extreme buyer saturation. A whole truckload, a trailer of buyers has appeared in the market. Well, these guys intend to settle anyway. They intend to, well, after that, close their own trades. Extreme buyer saturation has occurred here. And on the other hand, now you might ask me, sir, why didn't you enter with these volume spikes? Well, am I crazy to enter with these volume spikes that hit here while my liquidity is still there? Because see, these volume spikes are meant to consume this liquidity. Sir, these 1,000 orders that were here, for instance, right here, they had to be consumed, they had to be traded. And this aggression towards them naturally created these spikes. I don't trade with these. I trade when these are eaten up, when the market magnet, which was this liquidity, is gone. The market no longer has a magnet to hold the price. And then I wait for them to hit themselves with the next hammer, meaning I see a buy volume spike in the market, which is buyer saturation, and they spike yet again. And they apply their final push and pressure, and naturally, according to the strategy I mentioned, I enter in reverse, meaning I saw a buy volume spike here, so I enter a sell, which is exactly what I did back then. Because I specifically wanted to catch this, I executed this trade. meaning I enter exactly at that peak where I see the spike, and now I set my stop above. I had also gotten confirmation in the footprint, and you see that I took this trade. Now, at the moment, I took it $82.3 and a 1 to 5 trade, my dear friends. Just in one trade, guys. If you use these strategies, you can do it also, guys. So you shouldn't do something like this in a place like, I don't know, on the VWAP, or no, in ranges where the price has entered standard deviation. These were the tricks and those key points and the fine details that you won't find anywhere else. And it's only the FOMO team that's providing this to you for free and telling you, and I hope you appreciate these opportunities and the points we tell you, which I know you do. And you've shown us so much kindness, and I've seen everywhere how you're all showing us love, talking about us, and I kiss each and every one of your hands.